I walk through the financial district of Lower Manhattan today, and I see something that should deeply unsettle anyone who understands how national power actually works. The unease does not come from what is present. It comes from what is absent. For more than a century, these narrow streets were alive with noise, urgency, and ambition. The shouted orders, the frantic movement, the relentless pace of buying and selling were not merely symbols of wealth. They were the operational heartbeat of global capitalism. From these blocks, the United States priced the world. Commodities grown in Iowa, energy pumped from the Middle East, and microchips fabricated in East Asia all took their cues from the financial machinery concentrated here. That machinery has not stopped operating, it has simply relocated. If you want to hear the pulse of modern finance today, you do not go to Wall and Broad. You travel north hundreds of miles to the cold but increasingly dominant streets of Toronto. This is not poetic exaggeration. It is a matter of balance sheets, capital flows, and institutional migration. In one of the most rapid and self-inflicted reversals of economic leadership in modern American history, the United States has surrendered its position as the world's primary financial center to Canada. Historians will likely compare this moment to the shift from London to New York after the First World War, but there is a critical difference. That transition was driven by war, debt, and the exhaustion of an empire. This one was driven by legislation, it was driven by ideology, and it was driven by a catastrophic misunderstanding of how modern financial systems function. The estimated number attached to this exodus is staggering. Roughly $3 trillion in capital, assets, liquidity, and institutional wealth has left the United States in less than 2 years. To many Americans, this number barely registered. Headlines framed the story as Wall Street pain, and for a public long conditioned to distrust financial elites, the reaction was indifference or even approval. To a factory worker in Ohio or a retiree in Arizona, punishment for traders sounded like justice. The policy was sold as a correction, a way to extract accountability from a sector perceived as greedy and disconnected. But what has unfolded is not accountability, it is removal. This was not a tax adjustment. It was the eviction of an industry that underpins the entire economy when lawmakers imposed 5% transaction tax on every financial trade. They assumed markets would absorb the cost and continue operating with slightly lower profits. That assumption revealed a profound ignorance of financial mechanics. Modern markets do not function on large margins. They function on microscopic spreads executed at massive scale. The firms that make markets liquid, that ensure buyers and sellers can transact instantly at stable prices, survive on fractions of a cent multiplied millions of times, a 5% tax is not a mild inconvenience in that ecosystem. It is a structural impossibility. It exceeds the revenue generated by many trades. When profit margins are measured in hundredths of a percent, a half% tax does not reduce profit. It eliminates the trade entirely. This is why the consequences were immediate. High-frequency trading firms shut down operations in the United States almost overnight. These firms are often caricatured as speculative parasites, but that caricature ignores their actual role. They are the grease in the machinery. They provide liquidity. They narrow spreads. They stabilize prices. Without them, markets become thin, volatile, and inefficient. When the tax took effect, liquidity evaporated. Trade slowed, costs rose, volatility increased. The market did not become fairer. It became brittle. Capital, however, does not disappear when it encounters friction. It moves like water. It flows toward efficiency. While Washington celebrated its moral victory over speculators, Canada quietly recognized an opening of historic proportions. The Canadian government signaled to the global financial community that it would do precisely the opposite of the United States. It rejected transaction taxes, it offered regulatory clarity, it streamlined licensing, it welcomed capital rather than treating it as a political enemy. The result was not incremental relocation, it was migration on an institutional scale. Major American financial institutions began moving critical operations north. Goldman Sachs shifted trading divisions to Toronto. J.P. Morgan followed. Citadel established a major presence. Hedge funds, asset managers, legal firms, compliance consultancies, and financial technology companies followed the gravitational pull. This was not a symbolic gesture. Servers were moved, talent was relocated. Entire ecosystems uprooted themselves and reassembled across the border. Toronto did not become a satellite of Wall Street. It replaced it. This shift matters far beyond the fate of bankers. Finance is not a side industry. It is the nervous system of a modern economy. It determines how businesses access capital, how infrastructure is funded, how innovation is financed, and how retirement savings grow. When the center of gravity moves, control moves with it. Regulatory standards, risk pricing, and capital allocation decisions are now increasingly shaped by Canadian institutions and political frameworks. The United States did not lose jobs alone, it lost the control room. The tragedy is that this outcome was predictable. History is filled with examples of governments mistaking economic activity for a static resource. Capital is not loyal. It does not respond to rhetoric. It responds to incentives, stability, and returns. When policymakers assume they can punish markets without consequence, they confuse authority with leverage. The Trump administration's approach combined populist resentment with economic illiteracy. The intent was discipline. The result was abandonment. The legislative foundation for this collapse was laid with the Financial Accountability Act of early 2025. Framed as a reckoning with financial excess, the law imposed sweeping costs on every aspect of market activity. The transaction tax applied universally, touching stocks, bonds, derivatives, and foreign exchange. For long-term retail investors, the cost was noticeable but survivable. For market makers and institutional traders, it was fatal. Trades that once made economic sense became mathematical absurdities. The act also raised capital gains taxes on foreign investors from 20% to 35%. This decision was driven by nationalist rhetoric rather than economic logic. Foreign capital has long been a cornerstone of American financial strength. It finances deficits, stabilizes markets, and lowers borrowing costs. By raising the price of participation, the United States did not protect domestic investors. It pushed global capital elsewhere. Sovereign wealth funds and pension systems did not protest, they exited. Compounding these errors was a deliberate assault on regulatory predictability. Appointments to the Securities and Exchange Commission prioritized ideological hostility over institutional continuity. Rules shifted rapidly. Enforcement became inconsistent. Compliance departments found themselves navigating a landscape where legality changed with press releases. Businesses that plan decades ahead cannot operate under conditions of uncertainty. Investment stalled, hiring froze, confidence collapsed. The decision to ban cryptocurrency trading within the United States further accelerated the exodus. Regardless of one's opinion of digital assets, the ban eliminated an entire category of innovation and investment. Developers, capital, and infrastructure left immediately. Canada, by contrast, implemented a clear regulatory framework that allowed digital assets to function within the law. The message was unmistakable. One country closed doors, the other opened them. The cumulative effect of these policies was systemic failure. Liquidity vanished, foreign capital fled, asset prices declined. Retirement accounts suffered. The very citizens these policies were meant to protect absorbed the damage. Meanwhile, institutions with mobility escaped. Canada's response was not ideological, it was pragmatic. Under the leadership of Mark Carney, the country implemented a financial expansion strategy rooted in stability. Zero transaction taxes ensured liquidity. Competitive capital gains rates attracted foreign investors. Licensing processes were streamlined, regulatory frameworks were consistent, cryptocurrency was integrated rather than banned. Canada did not bribe firms, it reassured them. The market responded rationally. Within 18 months, Toronto emerged as the financial capital of North America. Construction cranes replaced skepticism, office towers rose, talent followed opportunity. The transformation was visible, measurable, and irreversible in the short term. The human consequences of this shift reveal its cruelty. Mobile professionals relocated and adapted. Others, anchored by family and community, were left behind. Careers evaporated. Expertise became obsolete. The decline was not organic, it was legislated. Financial markets rely on liquidity, predictability, and trust. These pillars were dismantled in the United States and reinforced in Canada. The outcome is visible in empty Manhattan offices and booming Toronto skylines. This is not merely an economic story. It is a story of national identity and self-inflicted decline. For a century, Wall Street symbolized American power. That symbolism rested on competence, not morality plays. By confusing punishment with governance, the United States surrendered leadership. Capital did not revolt, it relocated. The question now is not whether this happened. It is whether the country is willing to learn from it. How much prosperity is America prepared to sacrifice to satisfy populist impulses? How many careers, cities, and institutions must erode before stability is valued again? This shift did not require invasion or collapse. It required legislation, and it can only be reversed with understanding, humility, and respect for economic reality.